Canada is now an extreme example of how a government causes a crisis and will not take their foot off the gas pedal in order to calm everything down. They want it to hit a brick wall, and in due time it will. When a nation is drowning in debt, there's no way to get itself out of it without digging itself deeper and deeper until they realize their efforts had been futile. You came here for the truth, so let me unveil that for you. Today we're going to look at Canadian real estate. Let's begin. First I want to show you these charts, then we'll get into the articles. Let's start with the household debt to income ratio. You are seeing these numbers that have gone to new heights. In the US, we had seen deleveraging that had occurred after the financial crisis, not because they wanted to, but because they had to. In Canada, however, these have skyrocketed to new heights, and it has gone beyond 160%. In fact, when you look at the newest numbers, this chart only shows you up to 2014. These are a result of the mismanagement, let's be nice, mismanagement of the government and the central banks. They have reduced interest rates down so low to force people into getting into real estate, into stocks and everything else. They want higher returns, and also, hey, if rent and a mortgage is going to be the same price, why not just get the mortgage? In some places of the world, you can finance the property for over 100% of that property's value. So you have to wonder, why would anybody be renting right now? Simply, they have destroyed and distorted what is supposed to be happening, particularly with real estate. It's really ridiculous right now. Okay, now, this is a ratio of debt to income. We know about the debt. What about the income? We are looking at the hourly earnings, basically, comparing Canada to the US. It's a 24-month percent change annual. In Canada, this has declined, whereas in the US, they're showing here that it has been a very small increase. What I would say about this is that we have many people with diplomas, with degrees, and that has really diluted the whole market. You also have the fact that people have taken on well over $1 trillion in student debt. There's a lot of people that have gone to a lot of school, racked up a lot of debt. That's one part. And their income does not match what they are taking in debt. And that's a fact. There simply are too many people with, basically fighting for the same jobs, and there's no way around it. What the government tries to do is they hire temporary workers, try to get people employed, but we've seen the statistics before. People, they go to school, they have too much debt, they can't move out, so what do? They end up staying at their parents' house for an extended period of time. And there's nothing wrong with that. But there is something wrong with that if you want to move out, but you literally can't afford it. A lot of people, I showed you here on the channel before, where they were applying for jobs at McDonald's, making $9 an hour, and they had to have their bachelor degree. That's when you know that everything is messed up, to put it nicely. Real housing prices, US versus Canada, 75 to 2016. Just look at that. That has gone parabolic. And of course, it's not all of Canada. There are places in Canada where things remain very stagnant or grow very slowly. But when you look at the major city centers, whether it's Vancouver, Toronto, even Montreal, this is where the prices have gone. Now, again, you saw those prices come down during the financial crisis in the US. That's good news. That is great. A lot of people were able to basically be able to afford homes again as a result. And if you're the homeowner, you own that property, and the price goes down by 30%, let's say. If you are under the assumption that 10 years down the road, prices will be up again, you don't really have to concern yourself so much. But it's when people take the home equity line of credit, when they're taking on secondary mortgages, then they start feeling the burn. Look, the prices came back up afterwards, but not to the degree that you're seeing in Canada. Total Canadian loans secured against residential property. I love this. This is music to my ears. When some people read the news, they're looking for the sports pages. Other people are looking for politics. When I read the news, I get goosebumps when I see this. Look at what has happened. The amount of debt that people have taken on at this time is absolutely ridiculous. And the news doesn't cover this information. You will not see this anywhere. You need the facts. You need those facts to back up the arguments. Why will real estate crash? This is why. Why are stocks not going to do well? This is why. Because debt, because of margin, because of mortgages going far beyond what an individual can pay back, but they don't care. They don't care. They will give people so much money. In fact, there are ways, I've shown you here before, 1.5% down. That's all you need. 1.5% down and you can get a mortgage in Canada. That's how insane everything has become. But you think 1.5% is ridiculous? Fine. You can easily get it for 5%. That is even more commonly available. Don't worry about the fact that they said that they were going to tighten rules after the financial crisis. It will never happen here. It will never happen here. It will never happen here. It's going to happen here. You can't take out the equity from your home and at the same time interest rates are rising and not have that be a disaster. Okay? It doesn't take a genius to figure that out, I assure you. This is the big news, almost half of Canadian households don't feel financially prepared for further interest rate increases. 40% of respondents to this poll conducted on behalf of NMMP said that they fear ending up in financial trouble if rates go up much higher. Look, rates have barely gone up. Barely. A fractional amount. And this has been since the financial crisis. Think about that. It's not as if that happened within the last 3-month period. We are noticing this, looking back 10 years. Look how many times interest rates have increased and look at the degree they have increased. Barely. And they say, look, if rates go up higher, I'm screwed. 1 in 3 are already feeling the impact of higher rates. Why? Because they had some sort of variable rate mortgage. And as soon as the rates went a little bit higher, they got screwed over. As long as they were going down, they were doing just fine. They seemed to have more and more and more and more money. And then they took out their home equity line of credit, which more and more people have been doing in Canada. And they'll end up getting screwed over. It's clear that people are nowhere near prepared for a higher rate environment. The good news is that there seems to be at least the acknowledgement now that rates are going to climb, which might make people reassess their spending habits, especially using credit. And the fact is that they will not. That's a fact. 42% of correspondents said that they don't think that they can cover basic expenses over the next year without going deeper into debt. What have I been telling you for years? And this just keeps getting worse. The same number said that they were within $200 of not being able to cover their monthly expenses. Now that's crazy. Look at the stock market. Continues to increase. Look at the billions of dollars that are being squandered every single day that you see in the news. Oh, we're going to spend $1 billion on this. We're going to spend $1 billion on that. And meanwhile, you have people in such poverty. You have people suffering to one degree or another. And an individual, average individual, doesn't say if they're employed or not, but a $200 difference. And all of a sudden, they're in big trouble. Big trouble. That's a crisis. But you're not allowed to say that. Apparently. Quickly here. Toronto, where home prices have risen 50% over the past 5 years, faces the highest risk of a housing bubble among 20 global financial centers, according to UBS. Beating out Stockholm, Munich, Vancouver, Sydney, London, Hong Kong, going onwards. You're looking at such an extreme level now, it doesn't even make sense. Average home prices in the Greater Toronto Area surged to a peak of $920,000. That's not sustainable. Nobody earns enough to pay that. The average individual, anyway. Sure, there are people out there who can buy it up. There's no problem. However, the average individual cannot afford that. They simply can't afford it. Housing is supposed to be affordable for the average person. It's not supposed to be a luxury item. Sure, there are luxury properties, but the average house in the main city where the person is working, where you work, should correspond to the asset, but it doesn't. It doesn't do that. So you can live further out, but if you take the Greater Toronto Area as an example, these prices have gone into the suburbs where places are over $100,000. Average home in the suburbs, $1 million. $1 million for a property, and you're living in the suburbs. You have to travel in, let's say 45 minutes, an hour even, to get in to the city. It doesn't make sense. It doesn't correspond to reality. It doesn't correspond to history at all. And this is the stupidity that I see all the time, and I want to show you this because I want you to know what's really going on here. I struggle with every time, but anyway, don't worry. Canada's housing market isn't on course for a crash. Just don't expect Canadian home prices to continue at increased breakneck speeds. It will cool, but not crash. That's right. He's out of Oxford economics, so he knows everything. I've given you all the data. You can do what you want with it. I've been told by those in the real estate, in that whole business, everybody interconnected in with that, houses are going to rise. You ask the average citizen in Toronto, houses are going to rise. You look at the financial media, houses are going to rise. You look at the banking industry, houses are going to rise. And I'll tell you right now, they can rise. But if interest rates come up to a reasonable level, historically, let's just say 4%, the Bank of Canada puts up the interest rate to 4%. There's no possible way that they could ever sustain this. Imagine what mortgage rates would be at if the Bank of Canada sets their rate at 4%. There's no way. We need a proper correction so that the average individual could afford homes. But it's okay if they have to rent. There's nothing wrong with that. But it's a distortion among history. There's so many different ratios. Anyway, I'll end it there. Enough ranting. If you found this video informative, please give me a thumbs up. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. In the first book, actually, I get into a lot of the Canadian real estate. I talk about US real estate as well, global real estate. And then in my newer release, I talk about what we can do to mitigate this impending crisis. So if you're interested in those, just take a look at the links in the description below. Take care.